Welcome back to the channel. Today we're diving deep into what's happening with gold right now in February 2026. And I've got to tell you, the story unfolding in the precious metals market is absolutely fascinating. We're going to break down the key support and resistance levels, explain what's driving these massive price swings, and most importantly, look at where gold and silver might be headed next. So let's get right into it. As I'm recording this on February 9th, 2026, gold is trading around $5,008 per ounce, having just reclaimed that critical $5,000 psychological barrier that we've been watching so closely. Now, if you've been following gold lately, you know it's been one wild ride. Just to put this in perspective, gold hit an all-time high of $5,608 on January 29th, then absolutely crashed, dropping as much as 9% in a single trading session. We saw prices plunge all the way down to around $4,400 before buyers stepped in aggressively. That's a 21% drawdown from the peak, which is absolutely massive by any standard. But here's what's really interesting. Despite that brutal correction, gold is still up 72.5% year over year, and it's gained 9.45% just in the past month. This tells us that while volatility is extreme right now, the underlying bullish trend remains intact. The recovery we've seen over the past week has been particularly impressive, with gold bouncing right off a key technical support level that many analysts, including myself, had been watching. Let me walk you through the technical picture right now, because understanding these levels is absolutely crucial if you're trading gold, or just trying to understand where prices might go next. The most important level we're watching right now is obviously $5,000. This is a massive psychological barrier, and the fact that gold has reclaimed it after spending the previous week below this threshold is a bullish signal. When we talk about psychological levels, we mean price points that traders and investors collectively focus on. $5,000 is one of those round numbers that carries enormous weight in market psychology. Now, if gold can hold above $5,000 through this week, the next major resistance zone we're looking at is around $5,400 per ounce. This level represents the previous all-time high zone before we hit that ultimate peak at $5,608. Technical analysts identify this as a critical breakout level. If gold can push through and hold above $5,400, it would signal that the correction is definitively over, and we could be heading toward new all-time highs. Some analysts are even calling for a move toward $5,600 to test that January high again. On the downside, let's talk about support levels, because these are your safety nets if prices start to decline again. The first major support comes in at the 50-day exponential moving average, which is currently sitting around $4,550 to $4,600. This is exactly where the sell-off stopped in early February, and it's not a coincidence. Moving averages act like magnets in trending markets, and the 50-day EMA has been providing solid support throughout this entire bull run. What makes this level even more significant is that it coincides with late 2025 historical highs, creating what technical analysts call a confluence zone, where multiple support factors line up. If we were to see a more serious correction and gold broke below the 50-day EMA, the next support zone extends down to around 4360, where we find the October peaks from last year. Below that, we're looking at the ultimate support area around $3,900, which represents the 200-day exponential moving average combined with November 2024 lows. If gold were to fall to that level, it would represent a significant correction, but importantly, it wouldn't break the long-term bull market structure. This tells us that even with all this volatility, there's still substantial room for downside movement before we'd need to worry about the overall uptrend being in danger. Now let's talk about what the technical indicators are telling us. The Relative Strength Index, or RSI, which measures whether an asset is overbought or oversold, reached extreme levels above 90 during the rally to $5,600. Those are the kind of readings we saw back in 1979 and 1980 during the last major gold mania. When RSI gets that overextended, a correction isn't just likely, it's almost inevitable. The recent pullback has brought the RSI down to around 81, which is still technically overbought, but it's given the market some breathing room. Interestingly, some analysts are also noting negative divergence forming on the RSI, where the indicator makes lower highs while price makes higher highs. This is often a warning sign that momentum is weakening. The Moving Average Convergence Divergence, or MACD, is another key indicator we're watching. Most recent analysis shows the MACD remaining in positive territory, but with some bearish crossovers appearing on shorter time frames. On the daily chart, the MACD is showing negative values around -5.5, indicating that bearish momentum was present, but appears to be waning as we see this recovery taking shape. The key thing to watch here is whether the MACD line can cross back above the signal line and move into positive territory, which would confirm renewed bullish momentum. Looking at the broader chart patterns, gold formed what some analysts are calling an ascending, broadening wedge pattern. This is a pattern that typically forms during volatile bull markets, characterized by higher highs and higher lows, but with increasingly wider swings. The recent spike to $120 represented an extreme extension above this pattern, which triggered the sharp correction back down toward the pattern's support around $64 for silver and proportionally for gold. The fact that prices are now bouncing from these pattern supports suggests the structure remains intact, and we could see another leg higher as we move through 2026. So what's actually driving all of this movement? Why is gold behaving this way? There are several major forces at play here, and understanding them is crucial to forecasting where prices might go next. The first, and perhaps most important driver right now, is central bank buying, particularly from China. The People's Bank of China has now purchased gold for 15 consecutive months, with their holdings rising to 74.19 million fine troy ounces, valued at over $369 billion. This isn't just routine portfolio management. This represents a strategic, long-term repositioning away from dollar dependence. When the world's second-largest economy systematically accumulates gold month after month, it sends a powerful signal about confidence in fiat currencies and the global monetary system. JP Morgan is projecting that central banks globally will acquire approximately 800 tons of gold in 2026, continuing what they call an ongoing trend of diversifying reserves that shows no signs of waning. This creates a fundamental bid under the gold market that wasn't present in previous decades. Even when speculative money flows in and out causing volatility, that central bank demand provides a floor. The second major driver is growing concern about Federal Reserve independence and U.S. monetary policy. The nomination of Kevin Warsh to succeed Jerome Powell as Fed chair actually triggered that massive 9% single-day crash in gold on January 30th. Warsh is viewed as a monetary hawk who's less likely to tolerate inflation and more likely to maintain higher real interest rates. The market initially interpreted this as negative for gold because higher real rates traditionally make non-yielding assets like gold less attractive. However, the subsequent recovery suggests that other factors, particularly the geopolitical and currency diversification themes, are outweighing the interest rate concerns. Geopolitical uncertainty is the third major pillar supporting gold prices. We're seeing tensions rise across multiple fronts, from US-NATO friction over Greenland, to ongoing trade and tariff uncertainties, to various regional conflicts. When the global political environment becomes this unstable, investors reflexively turn to gold as the ultimate safe haven asset. It's been money for 5,000 years, and it doesn't depend on any government or central bank for its value. That's extremely attractive in uncertain times. There's also significant concern about tariff policies and trade disruptions. The early weeks of 2026 have seen erratic policy decision-making and shifting tariff threats that have created enormous uncertainty for businesses and investors. This policy whiplash, as some analysts call it, drives people toward assets that are insulated from political decisions. Gold fits that description perfectly. Dollar strength or weakness also plays a crucial role. Gold is priced in US dollars, so when the dollar weakens, gold typically becomes more attractive to holders of other currencies and tends to rise. We've seen periods of dollar weakness recently that have coincided with gold's strength, although this relationship isn't perfect because sometimes both gold and the dollar rise together during severe risk-off events. Now let's turn our attention to silver, because the question you asked specifically mentions wanting to know where the silver market might move next. Silver has been on an even wilder ride than gold, if you can believe it. Silver surged to an absolutely incredible $120 per ounce in late January, before crashing down to around $64. That's a drop of almost 50% from the peak. As of this weekend, silver was trading around $80, showing some recovery but still well below that euphoric high. The silver story is fascinating because silver has a dual nature. It's both a monetary metal, like gold, and an industrial metal used extensively in electronics, solar panels, and various manufacturing applications. This means silver responds to both safe haven demand and economic growth expectations. During the late January rally, silver was moving almost 3 times as fast as gold, which is typical in precious metals bull markets. The gold to silver ratio, which tells us how many ounces of silver it takes to buy 1 ounce of gold, compressed dramatically, falling from historical averages around 80 or 90 down toward much lower levels. This ratio has formed what technical analysts call a double bottom pattern at levels not seen since 1992, suggesting silver could continue to outperform gold over the longer term. The recent pullback in silver from $120 to $64 should not be viewed as the end of the bull market. Instead, most analysts interpret this as a healthy correction after an extremely overbought parabolic move. The relative strength index for silver had reached similar extreme levels as gold, above 90 on multiple time frames, which simply wasn't sustainable. Markets need to breathe, and corrections are a natural part of any bull market. Looking at silver's technical structure, there's strong support in the $50 to $60 range. This zone represents the breakout level from the massive cup and handle pattern that silver formed over multiple decades. In technical analysis, when prices break out of major patterns, those breakout levels often become strong support on any subsequent pullbacks. The fact that silver has already bounced from $64 and is now trading around $80 suggests this support is holding. If silver can maintain levels above $60, it positions the metal for another potential rally later in 2026. One critical factor unique to silver is the physical delivery pressure building at the COMEX Futures Exchange. Registered silver inventories, which are the supplies available for delivery, have dropped to only 103 million ounces, while open interest, representing outstanding contracts, stands at 429 million ounces. If even a quarter of these contracts were to stand for physical delivery, the system would be severely strained. March is shaping up as a potentially challenging delivery month, and if we see delivery pressures again in May or July, it could trigger explosive moves in silver prices. This fundamental supply-demand dynamic doesn't exist to the same degree in gold, giving silver a unique catalyst. Bank of America has made headlines with a prediction that silver could reach $309 in 2026 under certain scenarios. While that might sound extreme, it's based on the historical pattern of silver making massive percentage moves during precious metals bull markets. In 1980, silver briefly touched $50, which would be over $150 in today's inflation-adjusted terms. If we're truly in a similar environment of monetary uncertainty and supply constraints, triple-digit silver prices are within the realm of possibility. Citibank has also issued a bullish silver forecast, predicting $150 within 3 months, citing China's continued accumulation and the ongoing safe haven trade. These aren't fringe analysts making sensational predictions. These are major Wall Street banks revising their forecasts upward dramatically. So where do gold and silver go from here? Let's synthesize everything we've discussed. For gold, the near-term direction hinges on whether $5,000 holds as support. If it does, we're likely to see a move toward 5,400, potentially retesting the all-time high around 5,600. The path beyond that depends heavily on whether the bullish drivers we've discussed, particularly central bank buying and geopolitical uncertainty, remain in place. The consensus among major banks has shifted dramatically upward. Wells Fargo just upgraded their year-end target to $6,100 to $6,300, up from a previous forecast of only $4,500 to $4,700. JP Morgan matches that with a $6,300 target. UBS is at $6,200, Deutsche Bank at $6,000, and Societe Generale also at $6,000. Goldman Sachs is more conservative at $5,400. This clustering of major bank forecasts around the $6,000 to $6,300 level is significant. It represents approximately 21 to 25% upside from current levels around $5,000. These aren't wild speculative predictions. They're based on fundamental analysis of continued central bank demand, likely Federal Reserve easing later in the year despite Warsh's hawkish reputation, ongoing geopolitical risks, and concerns about currency stability. However, we need to acknowledge the bearish case as well. Citibank's base case scenario calls for gold to potentially fall back to $3,600 to $3,800, representing about 25% downside risk. Macquarie has a relatively bearish average target around $4,300. The main argument for lower prices centers on the idea that if real interest rates stay elevated, if inflation comes under control faster than expected, and if geopolitical tensions ease, gold could lose its safe haven bid and correct significantly. Additionally, some analysts warn that retail speculation has driven prices too high too fast, and when over-leveraged retail traders are forced to sell, it can trigger cascading declines like we saw on January 30th. For silver, the directional outlook is similar but with higher volatility. The support zone between $50 and $60 is absolutely critical. As long as silver holds above this range, the bull case remains intact, and another rally toward $100 or higher becomes likely later in the year. The key catalysts to watch are the COMEX delivery pressures in March, May, and July, continued strength in gold, which typically pulls silver higher, and any signs of increasing industrial demand, particularly from the solar energy sector. Silver's gold ratio breaking above resistance around 0.02 would signal strong relative strength in silver and could mark the beginning of explosive outperformance. The risk for silver is that its industrial component makes it more economically sensitive than gold. If we were to see a significant economic slowdown or recession, industrial demand for silver could weaken even as safe haven demand rises. This could create a tug-of-war that limits silver's upside or causes choppy price action. However, in most scenarios where gold is rallying strongly due to monetary or geopolitical concerns, silver tends to follow and amplify the move. Looking at the bigger picture, what we're witnessing in February 2026 might be the consolidation phase of a much larger, multi-year precious metals bull market. The breakout in silver's ratio to consumer prices from a 40-year downtrend, the recovery in the silver-to-gold ratio forming that double bottom pattern, and the fundamental shifts in central bank behavior all point to structural changes rather than temporary market conditions. If this analysis is correct, the volatility we've seen recently, as dramatic as it's been, represents normal corrections within a powerful uptrend rather than the end of the rally. The key for traders and investors is to maintain perspective during these volatile swings. Trying to catch every short-term move is extremely difficult and often counterproductive. The better approach for most people is to identify the major support levels we've discussed, understand the fundamental drivers at play, and position accordingly with appropriate risk management. For those bullish on precious metals, significant corrections towards strong support zones may represent opportunity rather than cause for panic. As we move through February and into March, watch the economic data releases carefully. The U.S. jobs report and CPI inflation data will be particularly important because they influence Federal Reserve policy expectations. If inflation remains sticky and above target, it strengthens the case for gold even with a hawkish Fed chair. If we see economic weakness, it could trigger rate cuts sooner than expected, which would also be bullish for gold. The geopolitical landscape also demands attention, as any escalation in existing tensions or emergence of new crises typically benefits precious metals. In conclusion, gold at $5,000 sits at a critical juncture. The technical setup suggests potential for a move toward $5,400 and beyond if current support holds. But a breakdown could see prices test $4,550 to $4,600 or even lower. Silver's wild swings have likely shaken out weak hands, and the metal now has strong support between $50 and $60, from which another rally could emerge. The fundamental drivers, from central bank buying to geopolitical uncertainty to monetary policy concerns, remain broadly supportive of higher precious metals prices over the coming months, even if volatility continues to be extreme. The consensus target from major Wall Street banks, around $6,100 to $6,300 for gold by year-end, represents reasonable upside based on current fundamentals, while silver's potential move to $150 or even higher remains plausible if supply pressures intensify. As always, do your own research, understand your risk tolerance, and don't invest money you can't afford to lose in these volatile markets. That's it for today's analysis. If you found this helpful, please hit that like button and subscribe for more precious metals coverage. I'll see you in the next video.